The new Fed chairman, Kevin Warsh, now presides over what some call a new era at the Fed. To get some insight as to what this new era may mean for our economy, we turn to our chief equity strategist and economist, John Blank. John, do you see a change to monetary policy on the horizon with Warsh's pledge to remake the Fed?
Terry, I think he's put these task force together to initiate a variety of change at the Fed. And it's a closet mechanism in my mind for him to push towards less visibility about what the Fed does. And frankly, more service to the president's idea of keeping rates lower, at least lower for longer than the other Fed members will want. So we have yet to see if this plays out into some agreement with Mr. Warsh or whether Mr. Warsh ends up presiding over a Federal Reserve board that basically rejects his ideas and moves ahead on its own independently. Because you have at the Board of Governors level, Terry, there's 7 of the 12 memberships that are based in Washington, D.C., and one of them remains Chair Powell till 2028. So in a de facto sense, take the title away from Chair Powell, but he still votes the same way and he probably carries the same sway. So this is a very unique situation. And again, it's going to only play out over time for us to understand just how Kevin Warsh plays out in this scenario.
Based purely on economics, what would it take to warrant a material change in monetary policy now?
Terry, we got a core PCE rate today that was very high, but the core PCE rate is what the Federal Reserve cares about because it's an economy-wide inflation rate. I would tell you it might be peaking here in June because of the oil shock, but they will actually hold off well into September and October to see the revisions to later numbers quarterly from now, literally a quarter from now, Terry, before they make any final decisions. But it's only going to raise their uncertainty that they already have violated their price stability mandate for 5 years. It's racing ahead of them, and they will take into account the Strait of Hormuz is open right now. They also take into account that the Strait of Hormuz can be closed at any time and got us right back into the situation we've been in for the last 4 months. So uncertainty will be something the Fed will price in, and they will basically put themselves still on track, albeit cautious, for a rate hike later this year.
So do you see the bull bear story and the economy being impacted by all of this?
Absolutely, Terry. We're in a bubble situation in a lot of stocks, and the way tech bubbles blew up in 99, 2000 was rate hiking out of the Fed. Already got rate hiking out of the ECB and the Australian Central Bank, and that will matriculate to the United States relatively quickly, and that can, in fact, push all these stocks down big time because liquidity is everything. And then once the Fed and these groups stop providing it, the prices go down.
What's the status of the wall of worry on the economy?
The wall of worry, Terry, has been climbed, and it's been climbed, and it's been climbed, and I wonder if there's any wall of worry left, which is actually bearish. So I worry that people have just skipped all the risks this year and are going to be surprised that some of them are actually salient.
Is the 10-year Treasury bond yield curve still concerning as far as it being a recessionary signal?
Terry, we're back down to 4.3 on the 10-year from, highs that were getting close to 4.6. This is tracking down with the oil price. Again, it's probably the verdict's a little too early on whether the Straits of Hormuz closed yet again, and that drives that 10-year back up again. So again, Terry, just minor movement in the 10-year rate to talk about. It's heading in the right direction for housing, but I'd be very careful that there'd be a spin here off the lows, and we go right on back over 4.5 to 4.6.
Which indicators then are you watching for economic signals right now?
Terry, like everybody, I'm somewhat mystified on the extreme bullishness because I see 2% growth rate for the U.S. economy generally as being fairly sustainable across the consensus for many months now. So there's been no movement up or down on the consensus. The U.S. economy is basically flat, and that should cause us all concern when everybody's deciding 2% growth is going to deliver 20% increases in prices on stocks forever.
That last Fed meeting prompted some hawkish market reaction initially. Is that normal considering there was a more hawkish tone at that meeting?
No, I think people are finally getting appraisal that the FOMC will continue to remain independent and will continue to maintain its statutory mandate. And as far as that the strong job numbers of the last 3 months have taken that part of their mandate off the table for the first time. That was what caused them to cut rates last year. Once that's gone, Terry, they've always been violating their price mandate well before that job thing. So one thing that market's not understanding is it's a relative difference as well as the overall prices. They have always been violating their price mandate, and they would have kept rates higher had the job market softened. So now that the job market is stabilizing and doing well, there's almost no case, regardless of what happens with the Strait of Hormuz, they will be hawkish.
Here now, 3 strong buy large cap stocks on your radar: Alby Marie, Dycom Industries, and Murphy USA.
Yeah, ticker ALB, Terry, is an interesting one to talk about. It's a specialty chemical company that makes basically chemicals for batteries. Back in 2023, this was a $300 stock. And at the lows in 2025, it was a $50 stock. So it's now climbed its way back to $150 over the last year. And we've got $13 a share in earnings next year, which is actually pretty good. So it's a PE of 11. Really strong surprises, 138% surprises, average of 75% surprises over the last 4 quarters. But you got to ask yourself if this is exactly what's going to happen to the AI bubble. The battery materials bubble of 3 or 4 years ago is forgotten. But if you can go to 300 to 50 in a stock like this, and then back up to 150, you might want to think the same about Micron, SanDisk, and all these other groups.
Dycom.
Dycom is an infrastructure provider, Terry. They also, we've talked a little bit about this, the infrastructure bubble that doesn't get as much attention as the tech bubble, but this stock was $150 last April. Now it's $500. And yeah, we do have $20 in earnings next year. That leaves a 30 PE on an industrial stock. We talked earlier on a different podcast about Caterpillar having a 40 PE. So now you're having a situation where there's another bubble that has not been discussed, which is an industrial stock bubble, and Dycom Industries Exhibit A.
Murphy USA.
Murphy USA, Terry, this is a big refiner, domestic independent refiner. I get the stock at $500 a share. It was $350, $400 coming into the year before the oil shock took off. So here you've got all kinds of estimate revisions around $30 a share, giving a stock, a 15 PE or something like that. But what you got to ask yourself is, where does this go after the Strait of Hormuz opens? So this is a stock where I would certainly be wary of it because of the underlying uncertainty around what happens in the Strait of Hormuz.
Our chief equity strategist and economist, John Blank, on the new era at the Fed and the economy. With John, I'm Terry Ruffalo.
This material is being provided for informational purposes only, and nothing herein constitutes investment, legal, accounting, or tax advice, or a recommendation to buy, sell, or hold a security. Do not act or rely upon the information and advice given in this podcast without seeking the services of competent and professional legal, tax, or accounting counsel. Publication and distribution of this podcast is not intended to create, and the information contained herein does not constitute an attorney-client relationship. No recommendation or advice is being given as to whether any investment or strategy is suitable for a particular investor. It should not be assumed that any investments in securities, companies, sectors, or markets identified and described were or will be profitable. All information is current as of the date herein and is subject to change without notice. Any views or opinions expressed may not reflect those of Zacks Investment Research as a whole.